Hey everyone, Brian Bogner and Greg Towner here with Parallel Financial, and we are excited to talk to you about our outlook for 2021. So let's get right into it. No reason to delay here. Let's go ahead and start with just a chart of the S&P 500. We always start our calls with this chart, and as you can see here, we're at all-time highs in the S&P 500, and so that's good, right? I mean, the stock market is continuing to move higher. Things are going up, but there's some interesting things that are happening. In the past, the S&P 500, when I say in the past, in the last 5 to 10 years, it's been the number one outperforming equity place to be. That is changing. Emerging markets here, which has been an underperformer compared to the S&P 500, is doing extremely well and back out here at all-time highs and actually even outperforming things here domestically. Not only that, but right, the S&P 500 is the 500 largest companies here in the United States. Well, small caps, as you can see, even going back last couple of years, been kind of flat. There was the drop back when we had the shutdown, and small caps are doing extremely well right now, right? So small companies are benefiting. International companies now are doing well. Commodities, what? Commodities have been in a downtrend for a while now, and now commodities are now catching a bid, right? Soft grains, when you think about commodities, there's three things. There's soft grains, there's energy, and then there's your metals. All of them are doing well. Energy is actually starting to come up well. So we're really starting to see some rotation and some things happening here. Interest rates. So when interest rates have been in a downtrend for a while, when the shutdown and lockdowns happened, the 10-year yield really went down. But what's happening is we're starting to see that reverse now, and interest rates start to move higher. The yield curve steepening. The 10-year yield is now back over 1%, which is still historically low. But we're starting to see some things happen that long-term trends are reversing, and we're seeing some rotation. We're seeing it here as well. The number one performing group and sector in the stock market over the past 5 to 10 years has been technology, okay? And you can see here, what we do here is we compare some of these other sectors to technology. So the first one is consumer discretionary, things like retail. We got basic materials compared to technology, industrials, financials, things like that. Well, if you look here, all of these are going down up until when we had that big sell-off back in March and April. And so that means technology was outperforming all these other groups. Well, now these things are starting to bottom and turn up. And so we're seeing this big rotation now out of the best performing group, which has been technology. What are the largest companies right in the world right now, right? Your Googles, your Amazons, your Microsoft, right? Technologies has been this big benefit over the last 10 years. Things are starting to turn and rotate now into some of these other areas. We're seeing it domestically with sectors. We're seeing it internationally. We're seeing it with different asset classes. And this is good. This is really good, which we're going to get to here in a little bit as we talk through some stuff. So I'm going to turn it over to Greg. And so I've given you a lot of good news here, but there's always some things that we're concerned about. Greg, take it away.
Yeah, a lot of positive news there, Brian. But ironically, it's the extreme positivity that we're seeing by a lot of investors right now, which is probably our biggest concern. This is a measure here called the put-call ratio. We don't need to drill down into what that is too much, but basically it looks at how much bearish bets investors are making compared to bullish bets. Right now, they're really making bullish positive calls. Really almost at extreme levels. If this chart went back even further, you'd see in the 90s, it was down at these levels for a long period. So it can't, it's not that it can't stay here, but just investors really by and large are quite positive right now. Even though we do hear some negative things from time to time, they're quite positive, particularly as we go into certain areas of the market. So, lately we've seen the IPO market, for example. It's had a lot of IPO frenzy, as we might call it. A lot of new issues come out, huge pop. We're at the top of this chart here. It looks back over time at the first day gains of IPOs. Really the largest we're seeing at any time, going all the way back to when we started our careers back in the technology telecom bubble of the late 90s. So the frenzy of these companies coming out. And then in the bottom part of this chart, most of them are coming out with negative earnings. Now, granted, it's a little different than back in the tech bubble days when a lot of these companies hardly even had business models, let alone earnings. A lot of these companies now are intentionally coming out with negative earnings, just to kind of try to push their growth and, use all their borrowed money to grow. But really, it's still quite concerning that we're seeing these huge gains from companies with no earnings. And on that note, particularly technology. I know you said that technology is starting to underperform, but that's really more the large caps. If you look at these non-profitable technology companies, this is their stock price here, what it's done in recent periods. So it's this kind of positivities that gets us concerned. Now, sentiment is a weird thing. It can stay positive for a long time. It can go higher than you can ever possibly imagine. I mean, I know, and I was rereading some history that we lived through back in the 90s here recently. I read comments from great investors that we highly respect 5 years before the bubble popped were saying, oh, it's over, I'm betting against it, what have you. So there's no way to know for sure when these areas of speculation will end. We just caution investors, hey, be very careful with this speculative money in some of the areas that you're playing in.
Well, I think it's interesting, though, that the majority of a lot of this bullishness and speculative that we're seeing, like your point is, it's in the technology space.
Yeah.
And so you could see, and let's be honest, valuations in the technology space are also, pretty high too. You could see that correct back down to some normal levels, but that doesn't mean, we always have to be careful. That doesn't necessarily represent the entire stock market. So,
exactly.
So we always want to be careful that when we're talking about these things, when we talk to clients and like, well, Apple's worth this, whatever. I mean, if that comes down, well, that's just one company, and yeah, it's important and things like that. But there's so many other things happening, and that's what we're starting to see life in a lot of these other areas right now.
Yeah, and so to kind of get back to what we talked about, why we think that rotation and more areas of the market doing well, this kind of sums it up. I know it looks a little messy, but let's simplify it here. That black line is the S&P 500 going all the way back to 1970. The light blue line is a breadth measure looking at when the percentage of stocks trading above their 200-day moving average. So recently we got to 90% of stocks were trading above their 200-day. Seems like a lot. Some people might say, oh my gosh, that's too much, the market's extended. But it's only happened a handful of times in history. And it turns out the market really likes that kind of strength. It happened often at lows or near lows, and there was a lot of upside left to go after that. So obviously we don't know that will happen. And like we said, some of the sentiment is of concern, but the broadening of the market move, in our view, is a positive. And it's not just the market. I mean, the economy is now starting to expand. Obviously, here in the very short term, we had a little bit of negative numbers as the COVID numbers got high. But we think we're actually early on in our next economic expansion. We had a recession during part of last year. Obviously, we all know what that was from. But in theory, now we're kind of resetting the bar, starting anew. As the vaccine gets rolled out more, that we expect the economy to continue to ramp up in the months and hopefully years ahead. So we potentially are early on in the next economic expansion. And what's driving that beyond obviously trying to get past COVID? The Fed's balance sheet, the central bank balance sheets, basically liquidity. Markets love liquidity, and they have been overruling sentiment concerns or any other concerns right now. There's just money awash out there, cheap money, low interest rates. So that is a large part of what's driving the market at this point.
One thing, now, Greg, we gotta talk about politics here, right? Because we can't have a conversation about the markets or the economy without bringing the political thing here. So let's do that here over these next two slides, because this is probably what I get more questions about than anything else. Take it away.
Yeah, we've gotten a lot of questions back, leading into November, in addition to the recent Georgia Senate elections. Just as we did 4 years ago, we got a lot of these questions, and our answers aren't too much different now than they were then, really. But this first chart shows us what has the market done when Democrats were in control of the White House and both sides of Congress. And so we see over time that those given years quite strong. Only 4 negative years, none of those were too bad. Over time, the historic returns were in line with historical numbers, if not above 9 to 12%. So historically, the market has either liked, or you could say it just doesn't care because it's focusing on other things when Democrats were in full control. So I know that's some investors had some concerns around that. And then we thought this was really interesting. This looks at the historic returns from the day of the presidential election through inauguration. And so we're now at that period. The current run for Joe Biden is now over 12%. So it's easily the largest percentage return for stocks from the election through inauguration. Now, that is not to say that the market just absolutely loves Biden or what have you. Maybe it does. But it's just to remind people that, hey, keep the political views and emotions separate, because the market is focusing on a lot of other things. It's factored this in all long ago.
Right.
I mean, you go back to last summer, you look at the polls and the betting odds, the market was assuming Biden was going to win, and possibly even the Democrats were going to take over Congress. So the market has long factored these things in, and so it's on to the next thing. So it's just keep that in mind. Keep the politics and the investing separate in your mind.
Yeah. To your point, there's so many other things affecting this, and usually way more than necessarily who's in office. It's important who's in office. It's important who's controlling Congress, and it does affect things. There's no doubt, but it's not the single driver of market returns and economic returns and things like that. So to recap, probably the most positive thing, and the thing that I know we're excited about here, is that there are other asset classes and groups that are starting to perform well and outperform and do well. And so, anytime you have a move in the market, you want broad assets and broad sectors and things like that. You want a lot of people and a lot of companies participating, and that's what we're starting to see. It's not just that, for a while it's been like, 10, 15 companies that have been driving a lot of the returns in the S&P 500. We're starting to see a lot more broad base. We're still early in this economic expansion. As Greg said, we had that recession, and we're expanding again. So that's really good. Liquidity by the Fed is really strong. And when you've got all this money, we say this all the time, don't fight the Fed. And if they're going to be easing and buying, so whether you agree with or disagree is irrelevant, right? We're investing. That's what we're doing here. But that is what's happening. And so asset prices are likely going to continue to move higher. Our biggest area of concern, though, is sentiment. Some things have gotten a little frothy. They've gotten a little ahead of themselves. People may be a little too bullish. And so a lot of times you'll see some corrections. And we think at this point it would just be a correction just to kind of settle that investor sentiment down a little bit. But that is our concern there. And then again, today's inauguration day that we're recording this video, and Democratic sweeps have typically brought positive returns. We can debate all the reasons why. It's irrelevant, but historically that's what it's done. And so, that's how we are positioned. All right. So if you have any questions, here is how you reach us. Thank you so much for listening today, and we will talk to you soon.